Last night, while you were asleep, your bank quietly raised your credit limit by $5,000. You didn't ask for it. You didn't apply for it. Nobody called you to check if you wanted it. It just happened, somewhere in the background, while you were doing something else entirely. And here's the part worth sitting with for a second. You didn't wake up $5,000 richer. Your actual debt hadn't moved at all. But your credit utilization could already look better, almost instantly, without you doing a single thing. Which brings up a question that doesn't get asked enough. If lending money is risky, and if a bank is supposed to be careful about who it hands more credit to, why would it hand you more room to borrow without you even asking for it? Because here's what keeps showing up in the research. When people get access to more available credit, a lot of them end up borrowing more of it. Not all of them, not dramatically, but enough that it's a pattern, not a coincidence. Which means a credit limit increase was never free money. It was never really a compliment either. It was a lending decision. And once you understand why the bank made it, that quiet little notification starts to look very different. This isn't really a story about you. It's a story about a decision that happened somewhere inside a bank's risk system, long before you ever opened the app. And understanding that decision tells you something important about how modern credit actually works. We tend to experience our financial lives as a series of personal choices. I spent too much. I didn't save enough. I should have paid that card off sooner. And sometimes that's true. But a lot of what shapes your financial behavior isn't a choice you made in the moment. It's a structure that was built around you long before the moment arrived. A limit that moved. A threshold that shifted. A system quietly deciding what's available to you and then waiting to see what you do with it. The credit limit increase is one of the clearest examples of this. So let's actually open it up. Start with the simple version, because the simple version is the one most people never stop to check. Imagine your credit card has a $5,000 limit. That number isn't a reflection of your savings. It's the maximum amount your lender is willing to let you borrow under the terms of that account. Now imagine the bank raises it to $15,000. Did you just become $10,000 richer? No. Nothing in your actual bank account moved. What moved is your borrowing capacity. You now have $10,000 more room to go into debt if you choose to. That's not income. That's not wealth. It's access. And access is a decision the bank made about you, based on information it has about you. So the real question isn't, why is my bank being so generous? It's, what does my bank think it knows that makes more credit look acceptable to offer me right now? Because credit limits aren't random. They come out of something banks think about constantly, which is risk. Every lender is essentially trying to answer one question about every customer. How much can we let this person borrow before the risk of them not paying it back becomes too high? Issuers look at things like credit history, existing balances, income information, and other account data to make that call. And in the United States, this isn't left entirely to a bank's discretion. Applicable rules require issuers to consider a consumer's ability to make required minimum payments before increasing a credit limit. And that requirement applies even when the bank is the one initiating the increase, not the customer. So somewhere behind that notification, a process ran. Your account was reviewed. A set of criteria was applied. And a decision came back that said, essentially, this account can handle more exposure. Now, I want to be careful with language here, because it's tempting to imagine something dramatic. Some algorithm quietly profiling you, predicting your future spending, waiting for the perfect moment to tempt you into debt. That's not what the evidence shows. And honestly, that framing gives the system more intention than it actually has. What's really happening is closer to automated credit risk decision-making. A system evaluating account information at scale and making a calculated judgment about how much exposure is acceptable. It's less a psychological trap and more an actuarial one. The bank isn't trying to predict your emotions. It's trying to manage its own risk. But here's where it gets genuinely interesting, because researchers have spent years asking a question that sounds almost too obvious to matter. What do people actually do when you hand them more room to borrow? Picture someone with a $2,000 limit who's already carrying $1,800 of debt on it. They're close to the ceiling. Nothing about their income has changed. Nothing about their existing obligations has changed. Then the bank raises their limit to $5,000. Suddenly, there's $3,200 of space that wasn't there before. Does that space just sit there, untouched, purely as a safety net? Sometimes, but not always. And the pattern researchers have found is consistent enough to matter. David Gross and Nicholas Souleles studied thousands of actual credit card accounts and found that increases in credit limits led to an immediate rise in debt. Their estimate for the marginal propensity to consume out of that new liquidity was somewhere around 10 to 14%, and the effect was larger among people who were already close to their previous limit. Read that carefully, because the nuance matters. It doesn't mean everyone rushes out and spends their entire new limit. It means that, on average, some portion of that newly available credit tends to get used. Not because people are careless, not because they're addicted to spending, simply because when the constraint moves, what feels financially possible moves with it. And we're not just talking about older research here. A 2026 Federal Reserve research note looked specifically at automated credit decisions and what happened after banks initiated credit limit increases on their own. The finding was strikingly consistent with the older data. Revolving balances rose by roughly 30% of the size of the credit limit increase. So if someone's limit went up by $10,000, the research suggests their balance tended to rise by something in the neighborhood of $3,000 of that new capacity. Not all of it, but a meaningful chunk. There's a second part of that finding that's even more revealing. Right after the limit increased, utilization actually dropped, which makes intuitive sense. More available credit against the same balance means a smaller percentage used. But over time, that utilization crept back up toward where it had been before the increase. And the Fed's research found that this recovery happened over roughly 6 months. Sit with that for a second, because it creates one of the strangest paradoxes in consumer credit. Your credit situation can look better on paper without your actual debt getting any smaller. Let's make that concrete, because the math is where this really clicks. Say you're carrying $4,000 of credit card debt and your limit is $10,000. That puts you at 40% utilization. Now your bank doubles your limit to $20,000. You still owe exactly $4,000. Nothing about your debt changed. But your utilization just fell to 20%. You didn't make a payment. You didn't reduce your balance. You didn't earn a single extra dollar. The only thing that moved was the denominator in the equation. And because utilization is such a significant piece of how credit scores are built, this actually matters. FICO treats amounts owed as roughly 30% of a typical score. So a higher limit, even one you never touch, can genuinely nudge your credit profile in a more favorable direction. But this is exactly where I want you to slow down, because there's a distinction hiding here that's incredibly easy to lose. A better credit score condition is not the same thing as better financial health. You can have lower utilization and the exact same underlying debt. The number on the surface changed. The reality underneath it didn't. So the limit increase itself isn't inherently dangerous. What matters is what happens after it lands in your account. Picture the version where nothing changes. Your limit doubles, your balance stays at $4,000, your utilization improves, and you simply carry on. That's a neutral outcome, maybe even a mildly beneficial one for your credit profile. But picture the other version. You look at your account and now there's $16,000 of available credit sitting there that wasn't there before. And slowly, without any single dramatic decision, your spending starts to shift. A trip you weren't planning starts to feel doable. A large purchase you were going to postpone starts to feel justifiable. Because look, there's plenty of room. An unexpected expense goes on the card instead of coming out of savings. Then another one does too. None of this feels reckless in the moment. You're nowhere near the new limit, so nothing about it feels alarming. And that's exactly the mechanism. You don't need to assume the bank is manipulating you into this. You don't need to assume there's some hidden persuasion campaign running in the background. The structure alone is enough. When borrowing capacity increases, some portion of people respond by borrowing more. That's not a character flaw. It's a documented behavioral pattern that shows up across thousands of accounts. And it happens whether or not any individual person is even aware it's happening to them. Eventually, if that pattern continues, the extra room becomes real debt. And that's the point where the economics of the situation change completely. Because borrowed money isn't neutral. It has a cost attached to it the moment it starts revolving. Federal Reserve data currently shows credit card interest rates sitting above 20% in its commercial bank credit card series. So if your new limit made spending feel easier, and your balance grew, and you didn't pay that statement off in full, you're not just dealing with the original purchase anymore. You're dealing with the cost of financing it, month after month. And if you end up making only minimum payments, the math turns unforgiving. Repayment can stretch out for a very long time, and the total interest paid over that stretch can end up dwarfing the original purchase. The exact calculation varies by card and by issuer, but the underlying principle holds everywhere. Minimum payments are extremely good at keeping expensive debt around far longer than anyone intends. Which is why the dangerous thought was never, my bank increased my limit. The dangerous thought is the sentence that quietly follows it. My bank increased my limit, therefore I can afford more. Those two statements are not the same thing, even though they feel like they belong together. The bank is telling you how much it's willing to let you borrow. It is not telling you how much you can actually comfortably afford. There's another misconception worth clearing up here, because it comes up constantly, especially with people preparing for something like a mortgage. You'll hear the claim that a credit limit increase automatically raises your debt-to-income ratio. It doesn't, and it's worth understanding why. Debt-to-income ratio compares your actual monthly debt obligations to your gross income. An unused credit limit isn't a monthly obligation. $20,000 of available, untouched credit is not the same thing as $20,000 of debt sitting on your record. But the moment you start using that available credit, the picture changes. Your balance can rise, your required payments can rise, your monthly obligations can rise, and that can begin to affect your debt-to-income ratio in a real way. So if you're the kind of person thinking ahead towards something like a mortgage application, the useful question was never, did my limit go up? It's, did my actual obligations go up? That's the distinction that follows you into every financial decision that comes after this one. And here's where the story stops being just about one bank and starts being about how differently the world has chosen to handle this exact moment. Because whether a bank can even raise your limit without asking you first depends heavily on where you happen to live. In the United States, issuer-initiated increases are permitted, provided the lender considers the consumer's ability to make required minimum payments. The system trusts the bank's risk process, with that one safeguard attached. Canada draws the line somewhere else entirely. For federally regulated financial institutions, express consent is required before a credit card limit can be increased. The default isn't the bank decides. The default is you decide. Australia goes further still, at least in one specific way. Card providers are not allowed to proactively contact consumers to offer them a credit limit increase. If you want more room, you have to be the one who asks for it. And the United Kingdom has built in its own protections, specifically aimed at persistent credit card debt, along with measures designed to give consumers more control over how and when their limits change. 4 different systems, 4 different philosophies about who should hold the decision. Notice that none of these are framed as banks are the villain here. It's more layered than that. Every country is essentially answering the same underlying question in a different way. How much freedom should a lender have to shape a customer's borrowing capacity? And how much control should sit with the person actually carrying the debt? There isn't a single universal answer, because there isn't a single universal comfort level with where that authority should live. So go back to that notification one more time. Congratulations, your credit limit has been increased. What it actually means is narrower than it sounds. It might mean your lender's internal risk assessment of your account shifted. It might reflect a routine part of how that institution manages credit exposure across its customer base. It doesn't automatically mean you're heading toward debt. It also doesn't automatically mean the bank is trying to bait you into anything. What it reliably means, and the only thing it reliably means, is that the amount of credit available to you has changed. And that leaves you with a choice, even if it doesn't feel like one at the moment the notification arrives. You can treat that new number as permission to spend differently, or you can treat it as flexibility you may simply never need to use. Those two paths look identical on the day the limit changes. they tend to look very different 6 months later. Because the limit was never your wealth. The unused portion of it was never income. And a lower utilization percentage was never the same thing as an actual dollar of debt being paid down. If you want to hold on to one thing from all of this, it's probably worth keeping 4 separate numbers in your head instead of letting them blur into one feeling. There's the credit available to you, which is simply what you're allowed to borrow. There's your actual debt, which is what you currently owe. There's your utilization, which is just the relationship between those two numbers. And then there's your actual financial health, which is a completely separate question about whether your income, your spending, your savings, and your obligations are genuinely sustainable together. These 4 things can move in completely different directions from each other, and that's exactly what makes this so easy to misread. Your limit can rise while your utilization falls, and your debt stays exactly where it was. That's one version of this story, and it's a fine one. Or your limit can rise, your spending can quietly shift upward, your balance can grow, interest can start accumulating, and your monthly obligations can climb, all while that same original increase still technically looks, on paper, like good news. The notification is identical in both cases. What happens after it is entirely up to what you do next. So the next time your bank tells you it's raised your limit, you don't need to panic, and you don't need to celebrate either. Just pause for a second, because the bank didn't hand you money. It handed you access. It made a calculated decision about how much exposure it's comfortable extending to you, based on a system built to manage its own risk, not to manage your life. Whether that access becomes something useful sitting quietly in reserve, or becomes another balance you have to carry, was never really decided by the bank at all. It was decided by the question you ask yourself the moment that number changes. Not, how much more can I spend, but, do I actually need more room to borrow in the first place? That one question is small, but it's the difference between a system working quietly in your favor and a system you never noticed. If you enjoyed this, subscribe and join me as we explore the financial systems shaping everyday life.